Welcome again. So we are continuing with our series on property, plant, and equipment under IPSAS 45. This is lesson 6. And the lesson 5, we have covered initial measurement. Now we are covering subsequent measurement. So you have your assets. You have the value of your assets and you have measured, you have classified. Now, what are you supposed to do in the subsequent periods? That's what we will be covering. So, so there are two choices or two models if you are in government. Most of the times, the two choices are the historical cost model and the current value model, of which the cost model is the one that is preferred. Why? It is simpler and it's based on history. We have the current value model. The current value model is what we used to call a revaluation model. It is a little bit more complex based on the current one. So if you look at relevance, which one will give us more relevance, relevant information? So between the cost model, because sometimes you can build a house, for example, just park for just say 100 or 200,000. Currently, that house is millions. So, shall we go with the current value or the cost model? Simpler one or the more complex, but which is more relevant to the current market? So the cost model, if we tackle it, every model has its advantages and disadvantages. It is simpler and objective based on the original cost. So the cost model also focuses on reliability over relevance. Focuses on reliability over relevance. You remember, relevance is one of the fundamental characteristics. Confirmatory, which talks about confirmatory, predictive value, and then free from bias. This one more about reliability. Then the value only decreases over time through depreciation or impairment. Example, county buys a vehicle for Kenyan shillings 4 million. After year one, accumulated depreciation say is 800,000. The current amount or the carrying amount is now Kenyan shillings 3 point. It's only decreased by depreciation or impairment. So you don't go back to the market and revalue again. You just continue with the depreciation. Depreciation, as we know, is a management estimate. So what is the current value model? The current value model always gives us, because it is related to the market value, gives us the relevant. It's more relevant and it's up to date. Reflects the asset current worth. The asset current worth. So uh, what the current value is different from the cost, historical cost model is that it requires regular updates to ensure the current amount is not materially different from its current value. So if an item, for example, like laptops, the way they keep changing or phones or machines, the way they are constantly updated, they require regular also updates because they can easily become obsolete. So that's one of the differences, and it is challenging, I know, because it also requires cost. You need money to revalue those assets. So if you look at the formula, carrying amount is equal to revalued amount minus subsequent accumulated depreciation minus subsequent impairment losses. So both of them are depreciated. Whether you revalue or not, both of them are depreciated. We also check for impairment. Why? Because we can't always be revaluing our assets every year. So this IPSAS recommends you revalue your assets between 3 to 5 years. So those that have quicker changes, technological changes, and may or are subject to those changes, then you revalue them after 3 years. So in those 3 years, then you can depreciate them. And then the other ones which take longer time, then you are allowed to go up to 5 years. For an example is a public university building has a carrying amount of 90 million. Due to rising property prices, it is revalued to cash shillings 110. So the new carrying amount is 110. And the initial carrying amount was 90 million. Where does the difference of 20 million go to? You have seen in the statement of changes in net assets, there is a place we normally call revaluation surplus. Revaluation surplus. That's where the difference will go to. So, revaluation. We have been talking about revaluation. Revaluation. What is this revaluation? There are principles which we follow. So, regularity. Revalue our assets often enough to make to keep the value, e.g., 3 to 5 years, which I've already mentioned. And then there is the consistency. When one asset is revalued, when one asset is revalued. So, if I remember the correct paragraph that talks about the classes, I think it is paragraph 34, if I'm not wrong, and this IPSAS 45. When one asset is revalued, the entire class to which it belongs must be revalued, e.g., all vehicles, not just one. For example, if you revalue one vehicle, then you revalue all vehicles. This prevents selective valuation. Selective valuation. Remember, consistency is an accounting principle. Consistency is an accounting principle. So we will go to our next example, but before we go to the next example under lesson 7, we need to understand how do we account for revaluation. Uh, there are two methods, elimination method. The accumulated depreciation is cancelled out against the asset gross carrying amount. The net asset is then adjusted to the revalued amount. So this also, if I'm not wrong, it's paragraph 31 and this is just 45. So you eliminate, you remove that depreciation from both uh, the cost and the accumulated depreciation. So this one is ideally either increasing the accumulated depreciation or returning it to zero, depending on how you revalue that asset. And then the other one is restatement method. The gross carrying amount and the accumulated depreciation are both restated. So this one is more difficult because you can increase it proportionately. For example, the increase is 3 million. The increase is 3 million. So you say 3 million divided by the gross carrying amount times the new value. So the difference or the percentage you are getting is what will increase in both the gross carrying amount and the accumulated depreciation, which will show in an example. So I will stop there. Sorry, I will stop there for today. Thank you for listening and enjoy your day. Remember, we have another lesson that is an example for both the cost and revaluation model under our lesson 7. Thank you for listening and enjoy your day.